In this video, I am going to share with you in detail the strategy I have used to quit my job and trade full-time. If that's something that you would like to do, spend a few minutes. Make sure you watch the whole video. It literally could change your life. So welcome everybody to I Am Trading. I go by Trader Joe. I'm a full-time day trader. You can find me in the mornings here on YouTube. I also have a private Discord community where I trade throughout the day. If you are interested, the link is in the description for that, but let me break down for you what it is I do day in and day out. First of all, I do not rely on indicators to enter a trade, nor do I rely on complicated concepts that you need a master's degree to understand. I trade price action. So watching the candles print on the chart, understanding how price moves, that's it. You don't need to know the inner workings of the stock market or write a master's thesis in order to be able to make money. Literally, if I can do it, anyone can. What I'm going to be sharing with you is my go-to strategy, and it's also the foundational building block of all the price action strategies that I use. But even using just this one, you can make an incredible amount of money, especially if you're leveraging funded accounts through prop firms like Apex. By the way, I am going to be releasing a video showing like one of my monthly payouts, just so you guys can see what is possible when doing it this way. And when that video is done, I'll put it up here somewhere. But if you want to go down that same road, get funded, get access to capital, you can use my code IAM to get the best deals possible at Apex. And that also supports this channel, so thank you. So let's get into the strategy. There are just 4 simple components: the channel, the level, the pattern, and the bar. When all of these 4 things align, you have a high probability trade that has edge over the long term. So let's get into it. In essence, this is a trend continuation strategy that focuses on high probability setups. So when the market is going in one direction or another, that's because there's institutional involvement, and our best bet is to join the institutions. We'll have a much higher probability of success if we are joining trends versus trying to predict the exact moment when the trend is going to reverse. So all the components to this strategy serve to identify a trend, confirm that the trend is in play and likely to continue, and locate the perfect entry to join the trend in a way that minimizes our risk and also maximizes our reward. So the first component to this strategy is the channel. And we use this to determine what the trend is and to figure out if it is in play or not. In order to do that, we need to learn this one simple shape. It may not look like much, but this is the backbone for all price movements. This is true on any instrument, any time frame, any day of the year. And we could go into market theory as to why this is the case, but that's really not needed. Just simply load up a chart or tune in during market hours, and you will find this pattern playing out over and over and over again. So we identify a trend using a channel, and this trend is in play until we see this shape. So that means this whole time we are only looking for longs. Even the first time that the trend is broken, we are still looking for longs, and we expect the market to make one more push to a new extreme. And once it does, right at this point, that is when the trend is no longer in play. And here, we are more likely to get a correction than to have the trend continue. So the same is true for the downside. If we identify a bearish trend using a channel, this trend is still in play until we get this shape. This whole time, yet again, we are only looking for shorts. Even when the trend is broken the first time, we are still expecting one more move lower. And then finally, when we get a new extreme of this channel, that is when the trend is no longer in play, and at this point, the market is more likely to correct than it is to continue. If you take anything away from this video, definitely take this away, because this is literally how prices move day in and day out. If you learn this, you're going to be able to start to predict price movement, which obviously can have a huge impact on your trading. So let's take a look at how this would work out on a real chart. The first step again is to identify a channel. We obviously have an uptrend here. That should be really obvious. And so our channel needs to clearly represent what is already happening on the charts. Some little pointers: you want to start the channel where the trend starts. So in this case, it'd be at the bottom. You're going to go to the bottom of the wick, and then you are going to continue that channel at the very first swing. So wherever the first swing is in the channel, you're going to go right to the body of that candle and then line it up with the other side. So the most important thing when drawing the channel is just for it to look good, for it to really look like it is representing price really well. You'll notice we have lots of touches, lots of confirmation on both sides of the channel, and it looks like it fits. Compare that to like if we had this kind of action and you were trying to draw the channel like that. It just doesn't fit the price as well. Look at these massive gaps between the edges of the channel and where price is at, and compare that again to where we had it, because ultimately these channels are just representing what is already going on the chart. So now that we have our channel, we know our bias, and we are only looking for longs this whole time until we see this pattern, right? And now we have a break of the channel. So that is this pullback leg of our channel. So we'll let this play out, and there we have our new high. So now this trend, this channel is no longer in play. The market is more likely to reverse than it is to continue. And so we'll wait, fast forward a little bit, and now prices are moving in the opposite direction, and we can identify another channel. Again, we want it just to fit the price action well. So we're going to start where the trend starts on the very top wick, and we're going to drag the channel to the closest swing right on the bodies. Okay, so going from the wick, going to the bodies, and again, look how well this confirms with price. We have multiple touches on both sides of the channel. It looks good. So that means that we are only going to be considering shorts until we get this pattern. We'll fast forward here. Only looking for shorts this whole time. And right here, we have a break of the channel. So we have this movement, and we will continue to look for shorts. The trend will still be in play until we get that new low. So let it play out here. Trend is still in play, and now we have that new low. So at this point, this trend is no longer in play. Our pattern has played out, and at this point, the market is more likely to correct to the upside than it is to continue. And playing it forward a bit, that is exactly what starts to happen here. So now we know how to identify a channel that is still in play. The next component to the strategy is the level. Trades work best when they are taken off key levels on the chart. We know we have a trend, we know we want to get long, but that doesn't mean we want to just buy randomly at any point in this trend. To give us the high probability of success, you want to let the market come to a key level. That is because you don't want to take a trade right here. Let's say you go long right here, and then you have to suffer a really long drawdown. So if we wait for the correction, then we can get an entry that has really good risk to reward, and we can ride the trend back in the original direction. So this key level can be the channel line itself. So waiting for prices to come back to the channel line right here. The key level can also be a break and a retest of some sort of support and resistance. So something like this, waiting for prices to come back there, is another key level. And it can also be an exponential moving average. I particularly trade with the 21 period exponential moving average. And there's nothing magical about it, right? It's not like 21 periods is the only way you can do this, but it's just a good middle ground as far as the periods go. For example, if you were to trade like the 3 period EMA, it's going to follow price really closely. Price is going to be back and forth between it. That's not going to be of much use to you. Inversely, if you were to trade too big of a period, let's say like the 100 EMA, it's going to follow price very gradually. You may never even come back to it. So using the 21 period, it follows price pretty well. Again, it's a good middle ground and it can create excellent entry points for trades. If you have multiple key levels converging at the same point, it makes your trade even better. So you can get multiple confirmation just by looking for all these key levels, and then you have a really high probability setup. So now for the third component to our strategy, the pattern. Now this is the real meat of the strategy. This is where it gets good. And by the way, if you're liking this video, please just click that like button, subscribe to the channel if you're not, to see more great content. We have our trend. We know the key levels we are looking for. Now we need the pattern. So let's say this is our trend and we have the 21 EMA, that's the key level we are looking for, and the market is pulling back to it and it is at our key level. So we've identified a trend, it's at our key level. Now we need to find an entry. So in order to do that, we have to be sure that this correction is actually over. Just because the market has got to our key level doesn't mean that it is just going to magically bounce every single time, right? It just doesn't work like that. The market's crazy, anything can happen. You know, we could correct a little bit more, or maybe we could have a full-on reversal. We need confirmation that the market is indeed going to bounce off of our level and continue in the direction of the trend. So let's think about how we might figure that out for a second. Using just what I have talked about in this video, what kind of pattern might indicate that the correction trend is over and is about to go back in the original direction? If you guessed this shape, you are absolutely right. Just like when we see this pattern, we know that a trend is played out and likely to reverse. When we see that pattern on a correction, we know that correction, which is just a miniature trend, is played out and the market is likely to reverse back in the direction of the original trend. See, I told you guys this shape is the most important shape you will ever learn. Let's see how it plays out on some real charts. So here is a channel that we have identified. We're looking for prices to come back to our key level, 21 EMA. Here they are finally touching our key level. And if we notice this correction, we can find this pattern. The market pulled back and made one attempt up. With this green bar, you can see it pushed up and then it pulled back again. And this green bar is that second push up. So we have a pullback, a first entry, a pullback, and a second entry. So we have the pullback. This pattern has played out. We're at our key level. And then that means that we would go long one tick above this bar. Our stop would go one tick below, and we could target I would say at least a 1-to-1. I like to target the swing high of the move because that is where we expect the market to go. There's lots of different ways to manage it, but this strategy is really finding the entry point. How you manage it after that is kind of entirely up to you. Another example, we have our trend in place. We're waiting for prices to get back to our key level. And again, we have our pattern playing out. Move up, break, one more move right at our key level. We're going to enter one tick below this bar, put our stop one tick above. And again, the target is completely up to you. You could go for 1-to-1 or maybe target the swing low. So that is the pattern component to this strategy. This particular component, there's a lot of nuances to it. I could do an entire video on just breaking down this sort of pattern recognition in more detail. If you'd like to see some of that content, comment below. But for now, we're gonna get to the last component, the last check mark of this strategy. And the last one is the bar. And this is absolutely critical. Keep in mind what we're trying to do here. We have a trend and currently it is going the opposite way, right? We are in a correction. The trend is going down currently, and we're trying to predict the exact moment when it is going to reverse course and head back in the original direction. We have three huge pieces to the puzzle, right? We have the trend itself. We have the key level. We even have this pattern. All those suggest that prices are going to go in our favor. And the bar is the final piece of the puzzle. Think about it this way. Which one of these bars looks the most likely to go up? This is indecision. This is kind of looking bearish. This has some movement upward. So we want a strong bullish bar if we're looking for longs, and a strong bearish bar if we're looking for shorts. We also want that bar to close above our key level. If we're looking for a long here and we're using the key level of the channel, we don't want our bar closing way down here. That is just indicating that we might go down farther. If our key level is the moving average, same thing. If prices are below the moving average, then they're more likely to go down than up in this scenario. So if we simply rely on this pattern to play out without a solid signal bar, we're setting ourselves up for a lot of unnecessary losses. Let's take a look at a few examples. Right here, we have a trend that is in play, check. We're at a key level, check. We even have our pattern playing out, check. But look at this signal bar. Pretty much a doji and closing well below the EMA. And what do you know? The market keeps going down. Compare that to this setup. We have similar trend, similar key level, same pattern, but then look at the bar. Nice bullish bar closing above the EMA, above the channel line, and this one goes on to be a winner. Let's look at some shorts as well. Nice looking downtrend, coming back to the key level. We have our pattern and even a decent signal bar, but it is closing above the EMA, and that goes on to be a loser. Compare that with this downtrend, also well identified. We're at a key level. We have our pattern, and this time we have a nice bearish bar closing below the EMA. And you can see that that goes on to be a winner. So with everything put together, the bar is the final piece of the puzzle. Even if you were just to use this simple checklist, you're going to see dramatic improvements in your trading. But the real key to being able to do this at a level where you can, say, quit your job is to be able to apply the strategy consistently in an ever-changing market, right? Because it's different every day. So For that, the best way forward is to get some guidance from traders who are more experienced than you, and also trade alongside others who have the same goals. For both of those things, really consider joining the I Am Trading team on our Discord. You can even get mentored by me personally. All that information is below. Anyway, let me know in the comments if you'd like to see more strategy breakdowns like this, and until next time, safe trading, everybody.